I'm Greg Hunter. Welcome to USAWatchdog.com. With us, a guy that manages about $400 million in funds. He's Axel Merk with the funds of the same name, Merk Investments. Axel Merk, thank you for joining us today from California.
Great to be with you.
You have your work cut out for you as a money manager to navigate not only the financial, the Federal Reserve, all the defaults, the banking, the regulation, and then the geopolitical. And let's start with Ukraine. It is heating up. Didn't get a lot of press last week, but boy, Ukraine is not going away, and it looks like we're stumbling towards war with NATO and Russia.
Well, if you think about it from a step back as an investor, what Putin wants, he wants instability. He used to have Ukraine as a buffer. Ukraine was at risk of moving towards the West, and he wants to have a buffer in the West. So he's interested in stability, and he's getting exactly what he wants. He's going to playing nice for a few days. Then the front against Putin is crumbling, and then again he does something. So he is an interest in this constant state of instability, and it's exactly what he's getting.
Well, some people look at this like, well, the U.S., funded this and, fermented this coup during the Winter Olympics in Sochi, and they, booted out their elected official, and they say that some of the people commenting, including Paul Craig Roberts, say that the U.S., NATO, wants war to cover up a terrible economy. What say you?
I don't think so much. I think it's really that Putin wants to rebuild the Soviet Union, and he doesn't like it that the West is moving closer. The West has its hands full. Germany for the longest time was fighting tooth and nail about these sanctions because they like to have the German economy trade with Russia. Now, of course, when you shoot down airliners, then you've got to take it a step further. With most of these geopolitical conflicts, once you take one step, you don't know where the next step is going to be. That's really the problem. And the economy is going to falter in Europe with any confrontation. It's the Japanese. They might like a military confrontation. The mindset in Japan is that you can ramp up GDP with a military buildup. And NATO doesn't do that. It's all the U.S. military spending anyway.
So what about Merkel coming out last week saying to the Baltic states that they're going to protect the Baltic states, Latvia, Estonia, things like that? What kind of positioning is that? Also, the NATO sending these dozen fighters to Bulgaria, and they stopped this Russian pipeline that was going to bypass Ukraine. Doesn't that ratchet up the possibility of war?
Well, the difference is Putin needs one person to make a decision, himself. Merkel is in a debating club. She talks. NATO is going to take forever to make any decision. Sure, those mills are grinding. They'll get somewhere at some point. But the NATO is very, very reluctant to do anything, and Putin knows that. So he does whatever he wants. He probably trades the markets as he's sending signals to the markets. He's probably having a blast back there behind his Bloomberg terminal.
And let's move on to ISIS, because this is the geopolitical world that you have to navigate and invest money in. And, we went from it's a JV team, junior varsity, that's no big deal. That's the president was saying this a few months ago. And last week, Chuck Hagel, the Secretary of State, is, get ready, watch out. This is, imminent threat. Senator Inhofe of Oklahoma is saying, hey, they want to have a plan to blow up a U.S. city. That's a big swing in a short amount of time for ISIS. What is going on in your investment world? How do you navigate that?
Well, let me give you an answer you might not be expecting, because let me draw it to monetary policy. The Fed is at fault with everything, right? Including ISIS and Ukraine. And the reason I say that is that we have fostered an environment over the last decade or 15 years by now where we are eroding the middle class by having these ultra-low monetary policy, by driving global overproduction. What's happening is that you have commodity prices high, where corporations get squeezed because you have no pricing power, you have a flood of goods because the final goods prices are low. And so what happens is that real wages stagnate in that sort of environment. In the U.S., we just have the rise of the Tea Party, of Occupy Wall Street. But what you got in the Middle East, you get revolutions because people can't feed themselves anymore. Ukraine, ultimately, the problem they have is they can't balance their books. They can't afford the gas. And so it's a common problem throughout the globe. It's the same problem in the U.S. and Japan and the Middle East and Ukraine. And we have to get back to sound monetary policy. Countries have to live within their budgets in order to make it sustainable. The people on the street don't think so. They just say, well, it's these bastards that take all the money. It's the governments, it's the foreigners, it's the minorities. And so that is why the Great Depression ended up in World War II, because it's the same sort of forces that play out when people get dissatisfied, when people have real wages stagnant for too long.
And, well, what you just kind of pointed out is that if that's what happened leading up to World War II, you're saying the exact same, scenario is leading up to, let's see, World War II, that'd be World War III. Is that what you're saying?
I'm not suggesting it's happening tomorrow, but political stability throughout the globe is on the decline. And we see that in the U.S. We see that how either you're on the left or you're on the right. There's no middle ground. In Europe, you have an erosion, social erosion. You have that in many places of the world. And there are a couple of things policymakers have in common throughout the world. One of them is they never blame themselves for the mistakes. They blame the minority, they blame the wealthy, they blame foreigners. And that's how they, quote-unquote, fix the problem. That's why you mentioned, why not some military engagement in Russia? I don't think Merkel is going to pull that off, but I think the Japanese might just pull it off somewhere. And so similarly, it's those sort of things. And of course, you don't know how that's going to play out tomorrow. Now, the good news as an investor is that our policymakers are quite predictable. And the place where this plays out is the precious metals market, the currency markets, because those things move when major policies are affected. And there you have a more direct projection of what do you think is going to happen next. And of course, something happening in the Middle East might be less relevant than what's happening in Russia because Russia can turn off the gas to Europe.
Well, let's talk about your one of your latest articles that came out. Are you ready for a Fed exit? There's a lot. I was kind of surprised that you're touting that the Fed is going to exit its quantitative easing policies, even though they've done a lot of shenanigans with buying bonds, supposedly, allegedly, in Euroclear over in Belgium with Euroclear, and a lot of people say they're not going to exit until the dollar blows up. What say you?
Well, it's about the perception of an exit, and let's first think about what has the Fed achieved. Right? I mean, they haven't achieved economic growth. But the one thing they have achieved is that risky assets appear less risky. You now buy junk bonds getting no yield. You now buy bonds in Portugal. Also, the stock market. Volatility in the stock market is down. So now if you have a perception of an exit, those risk premia have to expand again. Well, how on earth can you sustain asset prices if you just have the perception of an exit unless you have earnings go through the roof, for example? And so, yes, you can hope that, we'll print money forever, and that may well happen. But there's going to be these attempts on an exit. And as that happens, good luck that equity prices are not going to crumble. And so, while the Fed is exiting, what are you as an investor doing to prepare for that exit, even if it's just a risk that it's going to happen?
Well, you were talking about how some of these money managers are, worried about losing clients because they're too conservative. And so that instead of, having a money manager that's really looking after your principal, you're saying that, hey, they're getting paid for being really risky. Clients want them to be really risky. And when the money managers are holding back and trying to be conservative, they're losing clients. Explain that.
Yes, we wrote that in a recent newsletter. As you know, we manage mutual funds, so we talk to a lot of investors, including investment professionals. And indeed, some of the ones who used to allocate conservatively lost clients, and they said, hey, I want to be in business, so they invest more aggressively. And many investors, they don't want their investment professional for them to hold cash. Now, cash, of course, is risky as well because your purchasing power is at risk. But investors get furious when they pay for cash, even though that might be saving them. Now, in reality, the time to take chips off the table is, of course, when markets are up. There are lots of folks who said at the end of 2008, you got to double down. Well, yes, if you took chips off the table before the market crashed. But when the market has crashed, you didn't take precautions, you lost half of your net worth. It's completely irresponsible to put twice your money at risk. And so you got to take chips off the table. The question is, of course, where do you put that money? But in the current environment, if you haven't invested in the stock market, you look stupid. If you went out of junk bonds just had the biggest inflows last week for a very long time because people rushed right back in there because you look stupid if you took any precautions. Whereas the right thing to do is, of course, yes, you diversify, and diversification is not a label. You actually look at something where you could potentially get value when stocks crumble.
Well, you would be exiting the stock market now is basically the overarching you would be conservative. You would be looking to protect your money, and you're basically forecasting, listen, the Fed's going to exit. You should get out of the market because the stock market's going to take a hit. Is that what you're forecasting?
We have an equity mutual fund where we have taken, as earlier this year, precautions. We've been buying put options. We've been trying to protect ourselves. We've recently increased that protection. That's insurance. That doesn't mean you can't lose money on the downturn. But my personal allocation to stocks is very low. And to the extent that I'm exposed, I have put hedges in place. I'm very concerned. I'm spooked about the equity markets. And by the way, the folks that buy stocks buy so because they have to keep up with the markets. The folks that buy gold, for example, buy it because they like gold. And so just recently, we again had a few days in downturns. You don't have this rush to sell gold right now because the folks holding it are strong hands. Whereas in the stock market, if you ever have a wave of sellers, well, who says that not everybody's going to try to rush for that same exit at the same time?
And you'd be a gold holder right now. I know you have a part of your portfolio in gold, and you wrote a piece on why you like gold. And just briefly, why do you like gold? Why would you be a holder or a buyer of gold here?
Sure. And for full disclosure, we launched a gold ETF, of course, in May as well. So we certainly are committed to gold. There are a couple of reasons we like gold, but the medium to long-term reason is that I don't think we can afford positive real interest rates. We have a Newport Beach fund manager says that the new normal is 2%. Well, what do you think if rates are 2%, inflation is going to be higher, we're going to be living in a persistent state of financial repression. People talk about the exit, but if you look at real interest rates, they have been negative. They've gotten more negative of late. And Janet Yellen is promising she'll be late in raising rates. They're going to continue to be headwinds. So even as nominal rates go up, real rates are going to continue to be negative. And so I don't buy gold because of a crisis flaring up here and there, because those things can be short-term. Now, Putin has a long-term interest, of course, in instability in Ukraine, but mostly because if I look 10 years out, if you look at the projections of the Congressional Budget Office, and if you think that we might be going back to the historic cost that we've paid on financing our deficits, we'll be paying $1 trillion more a year to service our national debt. We can't afford that. And so that means, in my view anyway, that the Fed is going to keep rates low, so we're not going to be paying $1 trillion. And something is going to give. Well, you can play that in various ways, but gold is really the purest way to play those sort of scenarios.
I guess land, diamonds, artwork, anything tangible?
Well, certainly, by all means, and clearly, when gold goes up, and as it went up for 12 years in a row, it can't go up every single day when you have those sort of pressures. And there, similarly, diversification is key. Gold just has simple dynamics. Silver already, yes, silver might get up more, but silver is more volatile. And so everybody has to think about, well, what fits into their portfolio. As you know, we specialize in currencies. Currencies are much less volatile, but hey, they have some other problems. You can print them away. And so every asset class has advantages and disadvantages. Ultimately, investors need to be comfortable with the risk profile that they have. They need to be able to sleep at night with their investments. I'm not suggesting you have to have the gold under your pillow, but you need to be able to comfortable with it, including in environments where things are rough. And everybody knows that commodities and precious metals can be quite volatile as well when priced in gold.
And you said that you are spooked about the stock market. Elaborate on that.
Well, I can't be much more explicit than that. I fear a crash, and the reason I fear a crash is that when you have the markets go up relentlessly, your volatility go down, that means complacency is high, that means folks are buying equities that are not aware of the risks of the stock market. The moment that fear comes back to the market, for whatever reason, those guys are gone in a heartbeat. We saw it a little bit over a year ago, most recently in the emerging market, fixed income markets. Everybody thought they'd get a free lunch. Exit talk comes up. Suddenly these markets are a little more volatile. Everybody's rushing for the exit. It's a bloodbath. You see that. You saw it in the tech bubble, in the housing bubble. Complacency is the best bubble indicator out there. The timing is a little bit difficult, but you don't have to get the timing right. But it's more prudent, in my view anyway, to take the chips off the table before you have the problem than after you have the problem.
And one of the things that could start a lack of complacency to turn to fear And that's Senator Inhofe. I mean, you have Secretary Hagel saying that, get ready. I mean, imminent threat to U.S. and world. You have, which I was really surprised, Senator Inhofe of Oklahoma, who says, hey, listen, ISIS is planning to blow up a U.S. city. I mean, what happens if one of these attacks in America, a suitcase nuke or a dirty bomb or, some sort of a biological agent or something, or 10, ISIS people go into, Mall of America and open fire or whatever and commit terror. I mean, is that one of the things? It could be one of these moments that could go from complacency to all out, run for the exits, fear, run for your life?
I think we're trying too hard to look for that specific incident. It can happen for any reason. Now, with hindsight, I guarantee you a journalist will figure out what happened that day when complacency turned into fear. But in late 2007, we warned about complacency being kind of a huge threat to the market. And that volatility would rise, crumble these markets. With hindsight, yes, people found these specific entities were the problem. But at the time when we warned, nobody got it exactly why. And it doesn't matter. Think about it as well. The market has been climbing a wall of worries, that has been climbing on good news. It climbs on anything. Well, similarly, the market can go down on good news. The market can go down on bad news. It's an interpretation that happens after the fact. What we do know is complacency is high, valuations are high. Complacency historically is not at the level where it is right now, so something is going to change, and it doesn't really matter what it is. And so maybe we shrug off if somebody fires a shot in Ukraine, or maybe the market crumbles. Who knows? What I do know is that this market is very expensive. People are very complacent, so it's time to take chips off the table.
Axel Merk, Merk Investments, thank you very much for joining us today on USAWatchdog.com. Really appreciate you having you back. I hope you come back again.
My pleasure.